Hello and welcome also from my side or our side. I'm just going to share my screen and make it big. I hope you can all see that. So as Mario said, Olga and I will present the outlook for Central and Eastern European countries in the next 2 years as we see it. This is based on partly on a report that we did about 3 weeks ago, our spring forecast report, which we wrote together, and we will present the main findings of that. And then we'll also talk a little bit about more medium-term outlook and challenges for the region, and that will link to some of the things that we already discussed this morning. It was very interesting listening to the contributors this morning, and I think in some ways we agree, in some ways maybe we disagree. And it may also, we will look a bit, out towards the rest of the decade and hopefully then set up a bit the final panel of the day as well. I will start, Olga will take over, we'll do it that way. I wanted to mention at the start, I have a very distinguished co-presenter today. Olga, we found out yesterday, is the most successful Ukraine forecaster of all for last year for growth and inflation forecasts. So we're very proud of Olga about that. And especially if any of you have any questions on Ukraine, and especially the future of Ukraine, I think Olga is really literally the best person to ask about that. So the title of our forecast report, now we'll start with that, is Darkest Before the Dawn. And the idea of the title is we want to acknowledge how bad things are at the moment, how difficult the situation is in a lot of the region with the virus, but also that we think, tentatively, we hope the worst is over and that the recovery, really the proper recovery, starts here. And we'll try to lay out the reasons for that in the presentation. So we'll talk, I think, for about 40 minutes to leave plenty of time for questions. We'll start with the forecasts. What are our forecasts for the next 3 years for the region? Then a bit on the pandemic itself. Why is it being so bad in the region? Then the third section, drivers of growth. So what will drive the recovery from here? Number 4, and this is especially Olga's section, is the financial sector. How do things look there? Number 5, other risks that we see. So apart from finance. And then the final section, a bit more medium term, so Central and Eastern Europe in the 2020s. I'll start with the forecast. So what we see basically is that last year, at least, the region really outperformed Western Europe and the Euro area. So this chart shows real GDP growth last year relative to the year before. Blue bars are Western Europe, orange bars are our region, and the gray is the Euro area average. And you can see that with the exception of Montenegro and Croatia, which were very badly affected by, especially because of their tourism reliance by the pandemic, the whole region did better than the Euro area. So it's a relatively positive story, I think, for the region last year. Of course, very difficult year, not to downplay that, but compared to what happened in Western Europe, it could have been much worse. That outperformance, unfortunately, will not continue this year, we don't think. So this chart now groups the region into 4. So the gray, the dark gray, is the EU member states, the orange is the Western Balkans, blue is Turkey, and the light gray is the CIS and Ukraine. Shows real GDP growth relative to the previous year for 2020 until 2023. And then the blue dots is the Euro area. So you see for last year, as I said, clear outperformance everywhere over the Euro area in terms of the regional aggregates. For this year, that outperformance is much less clear. It is the case for Turkey. It is the case slightly for the Western Balkans, but for the region as a whole, there won't be this outperformance this year over the Euro area that we saw last year. That also applies to 2022. So again, few countries will outperform the Euro area. Region as a whole will not outperform the Euro area, we don't think. And then the convergence process starts again really in 2023. So that's when the region will again, as a whole, and most individual countries as well, start to go quicker than the single currency area. Going country by country, how we see that. This is a complicated table. I don't want to go through all of it. Down the left, I'll just highlight a couple of stories. So we have, again, the regional groups, and we have each country individually. And then the first 3 colored columns are the forecasts, color-coded. So green is the best, highest, red is the lowest. And then the 2 on the right are the revisions with the arrows, which show if they are up or down. So if we start on the left, you see for this year, a lot more green in Southeast Europe. So in the Balkans and Turkey, and partly that is success stories. So Turkey or Serbia countries which have used policy to come through this crisis pretty well, to be honest, so far. Partly it's base effect. So in the case of Montenegro, for example, a bounce back from a really savage recession last year with a very big tourism dependence. So really a base effect there. And certainly everything that was lost last year will not be made up this year. From 2022 and 2023, we see more than green in the EU member states, and that is a lot to do with the recovery fund. So, of course, there's a lot of uncertainty about EU fiscal policy, about when these funds are really going to arrive in the region, what the absorption capacity is going to be, how well countries will meet the criteria. That's all very uncertain, but we think that certainly it's a positive thing. Certainly it will have an impact. And so from 2022, 2023, and actually probably even more in 2024, after the forecast period, the EU funds, the recovery fund, will be a very important driver of growth in the region. Where there's quite a lot of red and orange is down towards the bottom in the CIS in Ukraine. This is unfortunately a familiar story. This has been the slowest growing part of our region for quite a few years now. And we don't think that that is going to change fundamentally in the forecast period. On the right, where we have the arrows and the revisions, you see a lot of downward revisions actually for this year, especially in the EU member states. And the reason for that is partly because last year was better than we expected, actually substantially better than we expected in some cases, like in the Baltic states, for example. But also the rather more savage wave of the pandemic, which hit the region over the winter. So in the first wave, the region did pretty well. It managed the pandemic pretty well. The death rate was fairly low. That has not been the case in the second wave for a lot of the region. And in many ways, it's the EU member states of the region which would be most badly affected. So there are a lot of downward revisions for next year. From 2022, things start to look better, and you see predominantly green arrows. So we've predominantly improved our outlook for 2022. Some of us are very much interested in economic history as well, and we like to zoom out a bit and think about the context. And I think this chart is quite important because for the global economy as a whole, this has been basically the worst crisis for 3/4 of a century. For the US, it's the biggest. Last year was the biggest annual downturn since 1946. I mean, it's a huge economic hit. That's not the case for our region. Our region has seen within the last generation something much worse. For Russia, for CIS and Ukraine, so that's the blue line on this chart, crisis is actually similar to what happened after the annexation of Crimea and exchange of sanctions. It's not as bad as the global financial crisis. The same applies for the EU member states. The orange line, also not as bad last year as the global financial crisis. Only the Western Balkans has really suffered substantially more than 10 years ago or 11 years ago. If we go back to the early 90s, though, you see that what the region experienced is absolutely not comparable with the transition recessions. I mean, in some countries, Montenegro, for example, it's definitely the worst year since the transition recessions, but it's not in terms of the scale of that comparable. So I think, in that sense, the region has come through this rather better than in previous episodes and better in that sense than the global economy as well. So as I said, the first wave, what happened last year, the region locked down very early, got on top of the virus, and that can help, I think, to explain a lot of why the region did better than Western Europe. Unfortunately, in the second wave, though, that hasn't been the case. And I think there are a few reasons for that. One is that simply restrictions have been much looser over the winter in the second wave than in the first wave. So this shows the Oxford Blavatnik School of Government Stringency Index. I'm sure you all know by now what that is. So from 0 to 100 in terms of stringency. In the first wave on the left, you see that the whole region reacted pretty aggressively, very steep tightening of restrictions at the start, especially in the Western Balkans. And Croatia, by the way, so Croatia is included obviously in the EU average. Croatia had at one point the tightest restrictions in the world, according to this index, during the first wave. So very restrictive in the first wave, very early lockdown, had a clear impact on cases, and it allowed economies to reopen. You see the clear decline in the stringency index over the summer. What we see in the second wave, where there have been far more cases in the region, is a much less response in terms of stringency. I mean, the only line on here which is in any way comparable with the first wave and the second wave is Turkey, the blue line. Otherwise, the stringency has been much less in the second wave than in the first wave. We see the same or similar picture when it comes to mobility, so how populations have reacted to that. This is Google workplace mobility data relative to normal. So the percent people going to the office relative to normal. On the left is the first wave, so mid-March to mid-May, very steep decline, more than 40% on average decline in workplace mobility across the region. So people really reacted, stopped going to work. On the right is the second wave, or a loose approximation of the second wave, so a kind of extended winter, November to February. And there you can see that the regional average is something more like 25% decline versus normal. Very different mobility response in the second wave. So both in terms of restrictions and in terms of mobility, we can say that basically there's been much more of a push to keep the economy going in the second wave at the expense of public health. And that you see here. This is data from The Economist. There are different ways to measure this. We took this because it has the broadest spectrum of our countries. And this is a measurement of so-called excess deaths, which accounts for the fact that not all countries, I think, report COVID deaths very accurately or openly. So this is really probably the best way to do it. And as of the end of March, 6 of the top 10 in the world in terms of excess deaths per 100,000 people were in Central and Eastern Europe. So Russia, North Macedonia, Bulgaria, Lithuania, Serbia, and Moldova. So really the second wave, this decision not to be as restrictive, this decision to keep more going to work, or being forced maybe to go more to work, has had a very clear public health impact on the region. What that means for growth. I think the most important point to emphasize here is that whereas in the first wave, and our colleague Branimir Jovanovic did a nice paper on this, which you can find on the website. In the first wave, there was a very strong link between public health outcomes and economic outcomes. So the worse the public health, the worse the restrictiveness, the worse the economic performance. There's a pretty clear relationship. In the second wave, that's by no means the case. So this disastrous public health situation in Central and Eastern Europe is not necessarily a disaster for the economy. And that's because we as societies, as economies, have adapted. And the future lockdowns are not going to have the same impact on economic activity as in the first wave. There are 2 charts I chose to show this, or others I could have chosen. The one on the left is global merchandise trade volume. It's compiled by an institute in the Netherlands. It's a real index we based to 2010. And then I put just the linear trend line, the dotted line on there. And you can see that the rebound in global trade has taken us almost back to trend, which is pretty remarkable. And if you look at the slope of this recovery in trade compared to 2009, you see it is much steeper. So this rebound in global trade has been really significant. The adaptation of supply chains has been, I think, very significant. On the right is a chart which I have to admit I stole from the IMF, but I think it gives a pretty nice picture. So this again compares the first wave to the second wave. Red is roughly their idea of the first wave. Blue is their idea of the second wave. It's a bit different to what I showed the previous chart, but it's the same story. On the bottom, you have the change in the stringency index, which I already talked about. And the left, the change in the composite PMI, which is services and manufacturing and construction, but mostly, obviously, services. The red dots are the first wave. So you can see big increase in stringency, big decline in economic activity. The blue dots are the second wave. There you can see actually, on average, only a very slight increase in stringency, and in some cases a decline even in stringency. And the same story for economic activity. So on average, a very slight decline, but in some cases actually an increase. So the economic impact of the second wave, even though it's much worse, or the third, fourth, whatever wave we're on now, is not necessarily as much of a problem for the economy as it was in the first wave. Beyond that, we think the big question, obviously, is vaccines in terms of the recovery. How quickly can vaccines be rolled out? How quickly can populations be vaccinated? And here we see huge divergence within the region. So on the left, we have some of the most famous success stories like Israel, also the EU average, the global average, for how long it will take based on current rates until 3/4 of the population are vaccinated. These are Bloomberg calculations. And on the right in blue for our region. And you can see that for Serbia or a lot of the EU member states, Hungary, Estonia, Slovakia, actually pretty good performance so far in the global comparison. This whole question about herd immunity is possibly feasible for these countries this year. On the other hand, countries on the right, so parts of the CIS, Ukraine, Western Balkans, it will at this rate, and we very much hope and expect that these rates will improve, but at the current rate, we're talking about years until 3/4 of the population is vaccinated. And of course, for those countries, that really does matter for the economy. So the divergence, I think, within the region is very important to note here. Once the weather improves, once lockdowns are eased, and we see that the impact of the lockdowns on falling cases, falling numbers of infections, we think the recovery will strengthen, will swing into gear, and the key for that is really going to be consumption, we think, and part of that is savings. So we've seen, this only shows the EU member states, but I think it's typical across the region, big increase in savings rates as a result of this crisis. This is partly just forced saving. People cannot go to shops because they're closed. Partly also insecurity, people not being sure about the future. But we see, if you look at Poland, for example, a substantial increase in the savings rate from last year to this year. Savings being, by the way, total income minus private consumption. We would expect, as long as things go in line with our baseline assumptions, so increased vaccination rates, better weather, the lockdowns have an impact on are then eased, that these savings will be substantially drawn down in the summer, and this will be an important driver of economic growth. Another reason why we're quite optimistic, I would say, on that the recovery can continue despite the difficult public health situation is policy. We saw last year policy had an important impact on driving growth, and we think that is also going to be the case this year as well, and that applies at the EU level. I already spoke about the recovery fund. The ECB is naturally a huge player and huge driver of everything that happens in monetary terms in our region, but also at the local level. And one part of that is the fiscal side. And on the left, we show the effective interest rate on public debt for our region compared to 2009 to last year. And you can see in most cases, and even in countries which still pay very high rates like Turkey, in most cases, we see a substantial decline in the effective interest rate on public debt. So the level of debt that countries can sustain is, all else being equal, higher than it was a decade ago. Borrowing costs are low. Countries can borrow. They can keep fiscal policy relatively loose, we think, this year. On the right, it's a similar story in terms of monetary policy. So this chart shows real interest rates, the nominal policy rate minus inflation. In February 2021, so the most recent month where we have all countries, compared to the long-term average, so since 2007. And you can see for a lot of countries, monetary policy in the recent historical context is extremely loose, much looser than has been the case over the last decade or so. The only exceptions are really the euro area countries, or the countries pegged to the euro. But for countries like Poland or Hungary or Serbia, which are some of the countries with the most optimistic growth outlook as well, according to our projections, this is a big factor behind that, the ability to run extremely loose monetary policy. And as long as the ECB keeps rates low, and I think that's almost as certain as you can be about anything, that is a certainty, there will be space to keep monetary policy loose also in Central and Eastern Europe. The final thing I wanted to mention was the external factors. So the global recovery is actually pretty strong. You will all know what's happened in the US. This is enormously important for everybody. I mean, the US, along with China, of course, still sets the tone for global growth. We cannot underestimate, I think, the size of the fiscal response in the US and the spillovers that will have for the global economy. There were some very interesting calculations by the OECD on that recently, which I'm sure many of you have seen. And this global wave of growth, driven above all by the US and China, we think will really benefit the region this year. And one way, I think, which is quite tangible is tourism. We saw this disastrous tourism season last year. I mean, a really huge shock in the tourism sector. This chart shows travel services credits last year, second and third quarters versus the year before, so the peak tourism summer season. You can see for most countries, the decline was 70 to 100%. So a really substantial decline. In orange, I highlighted the three most tourism dependent economies of the region, but tourism is important for a lot of the region. And it won't take much for this year, I think, to be substantially better than last in terms of tourism. So that was the overview of the growth drivers. And now I would like to pass over to Olga to talk about the financial sector.
Thank you so much, Richard. Richard already mentioned real interest rate dynamics, that it has been quite different compared to the global financial crisis. And overall, the dynamics of the financial sector has been quite different so far. The main difference was the speed of reaction of the central banks. When the pandemics broke out, the national banks all across the globe were very fast to provide sweeping liquidity, and this has been the case practically in all countries of our region as well. So the banks have had ample liquidity, and in addition to that, one major difference compared to the aftermath of the global financial crisis was different behavior of the parent banks in the region of the Central, East, and Southeast Europe. In contrast to the previous crisis, at this time they were not hasty to decrease the exposure to the region. Moreover, the figure on the left-hand side shows in many countries of the region, primarily mostly in all the countries of the EU member states of the region, there has been actually an increase in cross-border consolidated banking claims in the third quarter of 2020 and overall throughout the year. In CIS and Ukraine, the dynamics was different, and Turkey, but this was mostly to do with the volatile dynamics of the local currencies, domestic currencies. The recent banking lending survey showed that looking forward, parent banks are on average quite optimistic about their commitment, their operations and profits in the region. 60% of them indicated that they do not plan to decrease the exposure, and 40% even indicated some plans of increasing the exposure to the region. And another main difference compared to the previous crisis is that non-performing loans haven't increased. Moreover, in many countries, they have been on decline during the last year. To a large extent, this was due to bankruptcy moratoria introduced by the government in many countries. So the situation is likely not permanent, but nonetheless, banks would have felt relatively comfortable last year in terms of quality of their portfolios. And the balance sheets overall, the balance sheets of banks overall, they have been growing quite substantially as a result of all this development in monetary policy. However, there hasn't happened a proportionate increase in credit dynamics in the region. I show on the right-hand side credit growth of households in annual terms in the three major country groups of the region: EU member states, Western Balkans, CIS, and Ukraine. In corporate loans, trends were similar, though less pronounced in the CIS and Ukraine region. CIS and Ukraine, for a long time, they have been having consumer loans bubble building up, explosive growth, which now slows down dramatically, and it's a question of the softness of lending which happened there. So these trends, they have reflected the increased risk perception by the banks, who have tightened their credit standards, increased their loan rejection rates. Additionally, from the demand side, bank lending surveys also indicated quite substantial decrease in demand for loans, both by consumers and firms. In terms of households, this was mostly in the consumer loans segment, not housing loans, to which I come a bit later. So what has been happening with all the liquidity? Where has it been channeled? One major trend which has become evident already since the last crisis is that banks' balance sheet structure changed significantly with increase of debt securities in their balances instead of loans. So, and this was facilitated by increased government borrowing. And another major development has been increase in mortgage loans. There has been growing demand on the side of households for this loan, and this has caused substantial increase in residential property prices. So what was supporting this demand for housing loans? Obviously low real interest rates and increasing savings rates. So there were no other options to save money with any meaningful return. The same holds true for the banks, which looked for some opportunities to invest money with any meaningful returns. In many countries of our region, additionally, there were subsidized programs of mortgage lending by the state, and in Russia and some other countries, this had also had a significant effect on the dynamics of the market. As a result, residential property prices have been on the rise. It's been taking place in the Western Europe since the onset of quantitative easing, with countries such as Austria and Germany leading by the speed of residential property price growth. But Central, East, and Southeast Europe, they have been following suit, and the trends haven't really stopped in the pandemic year. Moreover, one can see on this figure of real residential property prices that are deflated by the CPI, that there was acceleration of growth, judging by the slope of the lines showing dynamics in major groups of countries in the region, and Eurozone and Austria serving as a benchmark. So this is somewhat concerning, and there has been a lot of talk among central banks about increasing risk of housing prices correction. Why would it happen? First, there can be an increase in insolvency of households and firms when the state programs of support will be scaled back. And basically, the question is how much unemployment will grow and household income will decrease after the programs are scaled back. And this will determine the impact on the mortgage loans market. And another factor is that there are some indications already in decrease of demand for mortgage loans, especially as prices grow that high that home ownership becomes increasingly unaffordable for a big part of households. There have been some trends of gentrification documented in major European cities. And so one has to be really on the watch out, and in order to prevent some hard landing in the market. That said, the banks are much better prepared now to deal with such corrections as they were in the aftermath of the global financial crisis, which is supported by the higher capital adequacy ratios. So the outlook is not that bleak, to end on a positive note. Another important observation, I think, which one can draw from the analysis of financial markets is that actually accommodative monetary policy, low real interest rates, they appear to be not that efficient in reviving business investment in the times of high uncertainty. And this is yet another indication of need of public policy in this respect in order to stimulate the investment in the region. Thank you, Rita. It's all on my part.
Thank you, Olga. I will continue now with some of the other risks that we see. I think, to be honest, Olga has really given the main risk, I think, quite a convincing case of the main risk, but I will just briefly mention three more before we go to the medium-term outlook, or four more, sorry. The first one is just uncertainty. This is the Global Economic Policy Uncertainty Index. I think many of you are probably familiar with this. The point really to emphasize here is that the current pandemic, which you see on the right in the red box, is an order of magnitude different in terms of uncertainty to anything that we've seen before over the last few decades. So compared to global financial crisis or the Trump election victory or any of those other things, we're dealing with much greater uncertainty now. And that's, I mean, I think in general, a risk to the whole outlook. The second risk is the labor market. What we see so far, this chart shows the change in unemployment that we can measure. For most countries, it's not that big, maybe surprisingly small change so far relative to what we might expect. Of course, it's a lagging indicator. I think this will change. We will see more of an impact. But I suspect also what we're seeing is that the headline data are not at the moment giving us a full picture of the underlying reality. And of course, included in that, what's happening in the informal economy. So I think the shakeout in the labor market from this whole crisis is maybe still to come. And that's also a risk. And I think links as well to what Olga was saying about the labor market. The third risk, and this is of course heavily discussed at the moment, is rising US rates. What we can say is, there's a good chance US rates will rise in the fairly near future. For our region, the US dollar is less and less important as a funding currency. We have to say that. We also see the chart shows in general smaller external vulnerabilities than in the past if we compare to 2013, the so-called taper tantrum. And here I think the country we really have to focus on is Turkey. Turkey is the country which still has the big dollar exposure, a lot of it short term, still the big external financing needs. So I think if there is a country in our region which is really exposed to these rising US rates, it's Turkey. The final risk is inflation. And what we see in the global economy, at the global level, is rapid rise in commodity prices. And that's energy, food, metals, wood, everything. And of course, that has an impact. What we see so far in our countries, though, is a limited pass-through. If you look at the PMI surveys, for example, the story seems to be at the moment, firms are responding by squeezing margins. They're struggling in this economic environment to pass these costs onto consumers. Our sense is that what will give is that this rapid rise in commodity prices will not be sustained. We don't expect energy prices to continue to rise rapidly, for example. We think inflation will rise, so the chart shows inflation for the forecast period versus 2020. We think it will rise, but not dramatically, and by the historical standards of the region, not actually especially high. So to finish the presentation, I wanted to go a bit more to the medium-term outlook and to address a bit some of the topics that were discussed this morning, and also to lead on to what will be discussed later. And I wanted to break this into three sections: the changing growth model of Central and Eastern Europe, the impact of the so-called mega trends, and then geopolitics or geoeconomics, as was mentioned this morning. And some of this is based on wiiw research. Some of you may have seen before, but I tried to put it all together into one story. The first issue is the growth model. This is research done by our colleague Roman Sterlinger on functional specialization. Some of you may be familiar with it already. Chart on the left is the smile curve, which shows where value is created along the value chain. It's mostly at the start and the end, much less in the middle in production. Unfortunately, our region, these are the charts on the right, is very much specialized in this production part of the value chain, much less at the start and the end where the value is. That mirrors in a way Western Europe. So here we show Czechia and Germany, but it would be the same pretty much any Central and Eastern European country and Western European country that we showed. And what we find is that, and we updated some of this for a forthcoming study, which unfortunately I cannot present the results because it hasn't been published yet. But what we find is that Central and Eastern European countries are very much too specialized basically in production, considering their level of development. And there's a risk that this is basically a development trap that they've got into. More generally, and it links very much to that, these are extremely export-dependent economies, some of the most export-dependent economies in the world, and mostly much higher than the global average. That's what the chart shows. And in a time of rising protectionism, potential trade conflicts, which we heard a bit about this morning, this is, of course, a risk for the region. The third element of this growth model, which I think has been brought into quite sharp focus by this crisis, is the whole concept of the so-called integrative growth model and the idea of this very high level of economic openness mixed with a small state. And Danny Roderick showed us already in the 90s that this is not really a workable model, that basically if you're a very open economy, you need a big state in order to make sure that the gains and losses of globalization are distributed fairly. The gray dots on the chart are Western Europe, and you go more towards the top left, that's where most of them are. This is big state, relatively closed economy by European standards. The red dots are Central and Eastern European countries, and you can see a lot of them are quite far towards the right and not especially high up, meaning very high degree of openness. relatively small state by European standards. And I think the nature of the current crisis, both in terms of the shock to the global economy and in terms of the rapid increase, overnight increase, basically in the size of the state and what citizens expected from the state, has really put this whole concept, this whole model under pressure. So that's sort of the first part of this medium-term outlook about the growth model of the region being increasingly under pressure. It was anyway, and maybe more so as a result of this crisis. The second part of this medium-term outlook is the megatrends. So one is the demographics. This was discussed this morning. In our region, the demographic decline of the last decades has already been basically unprecedented. Outside of a war or a famine, this basically never happened before. And the projections, that's the chart on the left, show that this is going to continue, especially for the working age population, so the economically active population, decline of up to a third by 2045 in a lot of the region. Now, this is a huge challenge, of course, but one hypothesis that we have, something that we've done some work on, is the idea that automation can provide part of the solution to this. So the idea that automation is a threat, that it's going to steal everybody's jobs. In the context of this demographic outlook, automation can be seen, I think, at least partly as actually an opportunity for the region. And on the right, we see it's robots per 10,000 people in the automotive industry. We see actually over the last decade, up to 2017 at least, very rapid increase in automation in a lot of our countries. Another one of the issues here is authoritarianism, state capture, the impact on institutions. This chart shows for all the 4 subregions that we have between 2007 and 2017, so this 10-year period basically after the financial crisis, there was a decline in the electoral democracy index produced by VDEM everywhere. This was not a Poland and Hungary story. This is very much a regional story. We can debate, the extent to which this really matters from an economic perspective. I mean, some of the countries most associated with this, like Turkey or Hungary or Poland or Serbia, pretty much the fastest growing economies of the region. But our sense is that at least for medium long term, this has implications for economic development. A couple of other megatrends, which I think are pretty interesting, maybe more positive and opportunities for the region. One is digitalization, and the digital economy in this crisis has received, of course, a huge positive shock. We've gone digital overnight. This conference is an example of that. The chart shows a survey done last year of EU countries, of people who started to work from home as a result of the pandemic. Western Europe on the left, Central and Eastern Europe on the right. Central and Eastern Europe, the share of people starting to work online is lower than in Western Europe. I don't think that's a huge surprise. It relates, for example, to the higher share of industry, lower share of services in the economy. Of course, industrial jobs, all else being equal, are harder to do from home. But we do see, especially in the more developed countries of the region, quite a substantial increase in the number of people working from home in this crisis, which suggests, I think, quite big digital potential in the region. And we know also outside of the EU member states, countries like Serbia or Ukraine, there are these digital hubs. These countries do have quite a lot of strength in this area. And so digitalization is an opportunity for the region. And one thing which it really may push, and this is obviously speculative, is I think for the last 30 years, but probably for longer than that, really since the Second World War, the defining feature of economic geography in Europe has been proximity to Germany. It's been a huge advantage in the development of complex industrial supply chains, the proximity to Germany. And if we really do get a huge permanent shift towards a more digital economy as a result of this crisis, it may change this economic geography somewhat, and it may create opportunities for countries that are a bit further away and have not benefited so much so far from the proximity to Germany. The final thing in the megatrends is the green revolution. And this is something I personally think is very interesting. I think it's very exciting and will be, I think, to an extent, the defining feature of all of our careers from here. And this chart I got from my colleague Nico, who did recently quite a lot of work on this, and we will be doing certainly more on this in the future, looking at the carbon intensity of GDP in Central and Eastern Europe. So this is CO2 emissions per unit of GDP. And the orange line, Central and Eastern Europe, of course, it's higher than Western Europe. It's come down, but it's still higher. But the research that we've done finds that basically this is an opportunity also for Central and Eastern Europe. Whether that's on the public side, you know, there's a lot of funds available, especially for the EU member states for the green transition, but also in terms of the private sector. There are many interesting things already happening in the region, and being a bit more behind in terms of carbon intensity is also, of course, an opportunity in terms of future growth from this transition. We are coming almost. We're at about 40 minutes. I don't want to go over the time. The last thing I really wanted to touch on was geopolitics and geoeconomics and how that plays out in the region. This chart, this slide I won't go through in detail. The idea here was to give a timeline and just to emphasize how much has changed since 2008. So I think until that point, it felt like a lot, maybe most of the region was on a pretty much one-way track towards convergence with Western Europe in economic sense, in political sense, in geopolitical sense. And I think that has been shattered by the last 10 years. It doesn't mean that it will not happen, but this sense of a one-way track towards the West, I think certainly if you look at it from the perspective of the non-EU member states, this has been in a way ended or at least cast into much bigger doubt by the last 10 years. And we see these two very important geopolitical fault lines in our region, I would say. One is between the West and Russia, with a pretty important contested zone in between, and one is at the global level between the US and China, but which also plays out to an extent in Europe. And these, I think, especially in the last 5 or 6 years, have hardened, and they matter a lot, especially for the non-EU member states of the region. They do have economic consequences. Ukraine is the most obvious example of that, but certainly not the only one. I wanted here, and don't want to take too much more time. I wanted here to just give 2 examples of how these conflicts, how these political conflicts can impact on the economy. On the left is an example from a study we did on the Donbass and the cost of reconstruction in the Donbass and how extremely expensive that is going to be. And on the right, what happened to trade between Kosovo and Serbia and Bosnia when, for political reasons, Kosovo raised tariffs to 100% in 2019. So these were just 2 examples of how these political factors can impact on the economy. The last thing I want to mention, this is really the last point now, is about the Western Balkans. And here I think is where a lot of these issues meet in terms of the geopolitics, the geoeconomics of the region. The Western Balkans is stuck in the waiting room for EU accession. The process is not moving, certainly not in a way that is satisfactory for the people in the region who want to join the EU. The economic performance that's on the left has been very disappointing. The convergence performance has been very disappointing. And on the right, a lot of people in the region, especially in Serbia and in Bosnia, feel that regional relations are going in the wrong direction. And we found in a study with Bertelsmann Stiftung, is linked at the bottom, very clear relationship between these 2 things, that the politics and the economics go together. Neither is going in a very positive direction at the moment. And the last point I wanted to emphasize, and this is one of the big findings of the study, is in terms of driving the Western Balkan integration with the EU, the key is really in Serbia. Serbia is the country where it's the only country where it seems that there isn't, clear desire among the population to join the EU. That's shown here. Also, from the perspective of the government, the situation as it currently stands is probably not too bad. Serbia is playing quite a clever game, I would say, between different actors in the Western Balkans. And without changing the Serbian calculation, it feels from our perspective like the whole integration of the region into the EU is going to continue to be very slow. So that's it. That was a lot. I hope it wasn't too quick towards the end. Just to conclude briefly, so the recovery is here for the region. It will be delayed but not stopped by what's going on at the moment, and we've seen already an adaptation. The growth drivers, I think, are clear: consumption policy, the global recovery. We see lots of risks, especially the financial stuff that Olga talked about. In terms of the medium term, I think over the last decade or so since the crisis, we've seen that the convergence process in the region can go backwards as well as forwards. And that means in economic, in institutional and geopolitical terms. The geopolitical backdrop has changed substantially. It's been accelerated, as we heard this morning, by the current crisis. And a lot of the region is a contested space with economic implications. The growth model has potentially reached its limit, at least for the more developed parts of the region. And finally, the pandemic certainly matters, but some of these mega trends, such as climate change and digitalization, are what will really define the region in the next decade and beyond, we think. And this should not only be seen in a negative sense, there are also opportunities for Central and Eastern Europe in this. So thank you very much for your attention, and we look forward to any questions that you have.
Thank you very much, Olga and Richard, for this very rich presentation. I would have a few questions myself, but let's maybe see whether in the chat audience has already some questions. There's Christoph Lebisch, who would like to know what the implication of huge governmental stimulus programs might be on future inflation. What is your take?
Well, it's a very interesting question. I mean, I think we can split up a bit between, what comes at the national level and what comes at the EU level. I think what comes at the national level is important. It's positive in the fiscal policy responses, as I tried to show, but it's not going to, close or, it's not going to dramatically change the situation with output gaps. I think the impact of that on inflation is not, I wouldn't say that, the fiscal stimulus in the region is going to drive massive inflation. The unknown, I think, is really what comes from the EU funds, because there the potential allocations are pretty huge. I think it's 40% of GDP for Croatia, for example, potentially. But there's huge uncertainty around this. We don't have all the plans yet finalized. We don't have full clarity on that. We don't know what kind of absorption capacity is going to be possible. We don't know really exactly when the money is going to come. As I said, we think it's going to be more a story of 2023, 2024, so towards the end or even after the forecast period. But I think there, if you look at the amount of money that's available, if that all really comes in a way that's expected, then maybe there is more of an inflationary case there. But I think the broad story of inflation, my sense is that nothing's really changed. Inflation is not there really in most of the region, and it hasn't been for quite a long time. There has been this deficit, this too tight fiscal policy in lots of places. But in the end, it links very much to the euro area story. I think for most of the region, okay, there are exceptions like Turkey, which is its own story, but for most of the region, it's very much tied in inflation, as is with many other things, to what's happening in the euro area, and there the outlook for inflation seems to be still very meager.
Okay, thanks. There are two questions by Georg Rauchenberg regarding the Ukraine. So what's the influence of the COVID situation on Ukrainian exports last year and outlook for this year? And what is also the outlook for foreign direct investment into Ukraine? Olga.
Yeah, thank you. Export developments were actually quite favorable already in 2020 for Ukraine, and they expected to continue in 2021. Basically, Ukraine could benefit from the increase in the global commodity prices, mostly agricultural commodities, but also chemicals. Recently, there has been a surge in metal prices with the recovery of global demand. So these are all key Ukrainian export commodities, and there the situation is quite good. So last year, there was only a 2% decline of goods exports in annual terms, and there was very high current account surplus as a result of this. When it comes to FDI, then it's quite bleak. The performance and the outlook for this year. Investment climate has been notoriously bad in Ukraine. Risks to investment have been growing due to numerous factors, lack of government's capacity to move forward with anti-corruption and judicial reforms for once, which now has caused pause in cooperation with the IMF, and the standby agreement was put on hold. But also there are geopolitical risks. Richard was already talking about Ukraine being as one of the areas where there is a lot of conflict and tensions. There were recent escalations from the side of Russia. So all this is not really conducive to favorable FDI performance. Last year, there was actually net negative outflows because of negative reinvestment earnings. And this year, one can hardly expect any real change in this trend. Thank you.
Thanks a lot. There are two questions by Dieter Pscheidl and Vladimir Warner, which I would like to combine because they deal with the European Green Deal and the question whether this could, the European Green Deal, whether this could stimulate economic growth in the region, and the question is in which sectors. And together, related to that, what is our take on the EU's recovery and resilience plan on the member countries in Central and Eastern Europe? So, what will be the effect of these?
Yeah, it's it's a very important question. It's one of the most central questions, I think, and it's of course a lot of uncertainty, which I hinted at in the previous answer. I mean, everybody's been very critical, you know, and it's always compared to the US, but I think we have to be realistic what we can expect, you know, from the EU. The EU is never going to be like the US. It's never going to be able to react like the US. And I think it is a step change in EU fiscal policy, and we should greet it anyway as a positive thing. That's my opinion. Like for the whole package, the amount devoted to green issues has been criticized, been not enough. But again, I think it's substantially more than anything we've had before. And I think, again, that should be seen, especially in Central and Eastern Europe, as a positive thing. You know, I can fully understand that the political economy of Poland means that green issues are seen differently to in Germany. I think, you know, there's probably not enough acceptance and recognition of that in Western Europe sometimes. But with the recovery fund, with the green funds, with the just transition fund as well, I think it's very possible to spin this into a positive scenario for Central and Eastern Europe, in my opinion. And I think, you know, this has to happen at a global level. It has to happen. The Chinese are very much on board. It seems how the Americans are very much on board. The EU has always been on board. You know, this is actually a very rare case, you know, thinking back to the discussion this morning, where actually we have basically a global consensus on this. You know, everybody agrees it has to happen. There's plenty of money for it. And I think that is how it should be seen in Central and Eastern Europe.
Okay, there is another set of, I would say, two questions related, Branimir and Vladimir. Basically, the question of the fiscal policy of the next couple of years, and where should it go? Would it be good to have basically, similar to the Biden plan, a big structural transformation package for the region in the post-COVID era, or else, given elevated public debt levels, should there be some sort of fiscal consolidation going on? What is your take?
I don't think there should be fiscal consolidation going on. I mean, who knows what a reasonable level of public debt is, but in this environment. But we know it's much higher than it used to be in the past, because we look at borrowing costs and we see they're so much lower. We look at the policies of the big central banks, and especially the ECB, and I think that, you know, a lot of the risks are really overstated in that sense. I think the countries have room to, maybe not like last year, but countries have room to keep, a lot of the region anyway, to keep fiscal policy pretty loose. I mean, I think for the EU member states, when it comes to big structural investment, I mean, the money is now there from the EU. You know, if they can absorb it, if they can meet the criteria, then the money is there. The question is really for the rest of the region. And I think it's, so Branimir and I already discussed this a bit this morning, but the disappointment, I think, in a lot of this is from a Western Balkan perspective, that, as you know, potential candidate countries on their way to the EU, very small in terms of GDP, very small from an EU perspective, that more wasn't done there in terms of investment plans. I think there could have been much more ambition in that region than what we've seen from the EU.
Thanks. Let me come back. Maybe I have a question. I was caught by Olga's slide on the rising housing prices. Basically a linear trend upwards. And at the same time, we have this information that the banks are doing actually quite fine. So I guess there is some kind of maybe relationship. So once we see the housing prices bubble bursting, the question is, when will that be? It will be at one point in time, but who knows when. And then probably the banks will be in problems too. How do you see this relationship of some sort of ballooning asset price bubble and the banking sector in the region?
Thank you. Yeah, this is a question which is troubling, I think, everyone. And we've discussed this with Richard on multiple occasions. So when and whether this break of trend should be, because the expansionary monetary policy seems not to be changed anytime soon. So there will be still plenty of money, no lack of liquidity. If indeed there is a really significant change coming from demand for mortgage loans and for residential property, if households become not, if they do not have enough income to generate increasing demand to finance this increasing prices, then there can be a correction of housing prices. The question is how hard it will be, and how diversified bank portfolios are. So now a big share of bank portfolios is into all sorts of debt securities. This is probably going to soften the blow. I mean, I don't think we are going to really see a major dramatic economic crisis coming out from this housing prices correction. Facts are also in favor of this is that so far the construction sector hasn't been really increasing supply of housing that much. So the multiplier effects will be limited in this respect. They will not go to the construction sector, the real sector of the economy. It's usually if there is not much construction boom, then this housing bubbles burst, have less profound effects. But you know, this all speculation, and I don't think even at the level of the central banks anyone has like really very high probability assigned to a scenario of any scenario of when and how it will happen.
Mm-hmm. Thank you. Well, then we come more or less to the end. There is another set of questions by Vladimir, which I would like to maybe combine to a certain extent, because it was mentioned that there is a need for a new economic convergence model for the region. But really, is there a feasible alternative to the FDI-driven model, given the state and level of local, for instance, educational systems? And related to that, might it be that we will see in the future Chinese FDI replacing Western FDI?
The first question is really important question, but it's a little bit difficult for me to answer because we just completed a study on this, which we will present in a couple of weeks. So I cannot really say too much about the conclusion. I think it's not fair to our client. I think what I can say, it's an important question. It seems to be the case that certainly the more developed countries of the region are slowing down in terms of convergence. And maybe this model will not take them all the way to, you know, German per capita income levels. And I think, you know, I can say in a very general sense, the whole role of national innovation strategies, of, as mentioned, the education system, this is all part of, I think, part of the answer. And I think the green aspect of that is very important as well. About China, I think my sense is what we will see. I mean, there was a bit of talk this morning about the German perspective. I mean, for me, and I think for a lot of people, it's been pretty obvious all along what Germany would end up doing. You know, it's been like watching them take a decision they were always going to take in slow motion, and there is going to be a harder attitude, and it was always going to be the case, I think, in terms of Chinese investment in the EU. But I think that definitely does not apply to the non-EU member states. I'm very much skeptical of this idea that China's economic influence in the Western Balkans will be reduced as a result of this crisis. I think, if anything, it will strengthen. You know, there's the need, there's the desire for the kind of investment that China can bring in infrastructure, for example, in that region. And so I very much doubt that China is going to go away. I think, you know, we will see this kind of maybe circling of the wagons in the EU member states. But if we talk about so-called wider Europe, I think China's economic footprint is going to be pretty significant in the future as well.
Thank you very much. Well, then.
Just a short comment
Olga,
in
sure.
terms of digitalization prospects. I don't think that the region is really that badly equipped, because there are all sorts of indicators that show that the quality of infrastructure is there, the share of people with STEM education is relatively high, so it's not going to be really a problem. And another beneficial factor actually is that the region is not that locked into all technologies. There is a benefit of coming late, so that can be an advantage.